Following the disastrous result for the meaningful vote on the government's Brexit deal, should investors and traders feel that the trend is more likely to see movement towards either a soft Brexit or no Brexit at all, in other words, remaining with the EU, or does the political impasse move us closer towards leaving the European Union on WTO terms, crashing out as some would have it? What does it all mean for the markets? William Hobbs is Chief Investment Officer of Barclays Investment Solutions, and he joins us now here in the studio. Will, good to talk to you. In your client note this morning, one of your first points was what next? And I think really we do have to get into that to move us on from where we are at the moment. How do you feel about where we are as an investor and a trader in these markets?
It's difficult, Jeremy. I mean, one of the things that we made, one of the points we made to our clients on the calls and the notes was that the greater the confidence with which someone predicts what's coming next, the less you should trust them. The political process is fluid, unpredictable, but we can take some consolation, I think, as investors from the fact that the UK economy has long since ceased to play a major role in the global economy, and that's where the direction of our capital markets tends to go.
Yeah. Let's take a look in some more detail about what's happening more locally and how connected are markets to politics.
Yeah, so, well, the interesting thing, the major sort of connection seems to be through the currency and the bond market, I guess. And you are seeing some sentiment effects in stocks, which may be providing an attractive opportunity there. But the interesting thing was it was very clear that sterling had already discounted a lot of the bad news, and hence you saw that bounce back late last night, back to levels where it was trading the day before. So, yes, politics can be influential, but I think the main thing to think about with regards to the influence is, in a sense, there is, if you're looking at a range of probabilities for Brexit. On the one hand, you have no Brexit, and on the other, you have a hard Brexit, which you just described, you know, the proper crash out with not even a kind of hastily stitched up bilateral deal on emergency stuff like medicines. Now, those two probabilities are at either end of the probability distribution. They're relatively small. In the middle, you've got a huge lump of deal that doesn't really matter. Some form of deal exit or some form of managed exit from the European Union, and that, to a certain extent, is more or less important to capital markets in reality.
And of course, the European Union doesn't want to change the deal on the table. So where do we go politically? I know you're not a political analyst, but I think the markets do need to know nonetheless what happens now because they need visibility. Crashing out would give us a certainty, a certain certainty. Staying in the European Union also gives us a certainty. That bit in the middle drives uncertainty in the markets, and that's very difficult.
To a certain extent. I mean, I think one of the things that we learnt last night and over the last couple of weeks, Jeremy, is that if there's anything that Parliament seems to agree on, there's two things, really. One, they hate this deal on the table. That's very clear from last night's vote. The other thing that they can agree on is that they seem to want to avoid a hard Brexit. That seems to be why markets are pricing a slightly greater chance of a soft exit or no hard Brexit, a slightly smaller chance of hard Brexit coming through overnight.
So as a money manager of clients' money, are you not interested in the markets at the moment, or are you still finding pockets of interest into which to place client money in these uncertain times?
Well, one of the great opportunities for investors generally is where sentiment starts to distort pricing, efficient pricing. You're seeing it in the world economy at the moment, in a sense, because the world's investors are getting a little bit itchy trigger fingers with regards to the chronological age of the economic cycle. So in our opinion, they're getting a bit too early to price in a recession. And with regards to Brexit, they maybe, you know, if you look at the world's asset managers outside of the UK, it's well known that quite a lot of them are underweight UK assets. That may be giving us an opportunity. One of the things that we noticed, if you look at the spread between the realised UK dividend yield and the 10-year gilt, it has not been this wide in 118 years of data, which is really quite an extraordinary thing. So you've got a forecast dividend yield of 5%. Now that looks payable to us, and that looks pretty attractive for strategic investors.
Well, I was going to say, what does that mean in layman's terms? So it means that ultimately you do like the look of these markets.
Yes, and the thing is, you've got to make a distinction with the UK between tactically and strategically, because the problem UK suffers from, UK stocks suffer from, is not necessarily Brexit, but it's quite defensively oriented. So you've got quite high exposure to consumer staples, pharmaceuticals. Your banks are quite boring relative to other parts of the world, and that leaves you with a little bit shy of cyclical skin in the game if you think the world economy is still going to do okay. However, if I'm a 5-10-year investor, the thing I'm looking at is valuation and a belief that, you know, there's still going to be innovation going forward. The FTSE offers quite an attractive entry point on that framework.
Yeah, what would the markets like to see in terms of the hurdles we have to clear? Clearly, some sort of end to the Brexit impasse. But before we get to that point, what do you want to see? Economic data coming through which is giving you confidence, or is it some event politically that will see us steer back into risk on?
Yes, so the problem with risk on, I mean, I guess for just UK constrained investors, if you're risk on globally, then you're going to get left behind a little bit because of that cyclical attraction, or that slightly lesser cyclical attraction. But really what you just need is just to continue to move through this process. With every kind of hurdle hopped over, you get a little bit closer to that kind of, being able to focus back on the fundamentals to a certain extent. We're moving in that direction, but the Brexit process is still going to be in our eyes for some time to come, one suspects.
Yeah, okay, well, we'll leave it there, but thanks indeed for joining us. William Hobbs is Chief Investment Officer at Barclays Investment Solutions, joining us in the wake of that meaningful vote and the disastrous outcome for the government.